Hello, I'm John Pearce. Welcome to this investment update. Having just finished another financial year, in this update, I'd like to take a look at how some of our options have fared. I'd like to explain why the Australian market has underperformed once again. And finally, I'd like to address one of the most frequently asked questions. Is the tech sector in a bubble that's about to burst? On your screen, you have the performance of 4 options. The best, the worst, and a couple in between. Let's start with our balanced option, which of course is our largest option, now well over $60 billion. 10.4% for our accumulation members, 11.2% for our pension members. Now, I'm pleased to say that this compares quite favourably with our major competitors. And that 11.2 for our pension members, well, that's 4 consecutive years of double-digit returns. Now, you might recall I've repeatedly said over the year that that was a result that was highly unlikely, if not impossible. Do you have moments in your life when you're really happy to admit that you're wrong? Well, I'm having one of those moments. But look, it's only 1-year returns, so no bragging rights. Bottom of the table, we have the bond option, 1.2%. Now, with interest rates where they are, how can a bond option only return that? Well, the fact is Australia has an inflation problem. And with rising inflation, we've had rising bond yields. With rising bond yields, we have falling bond prices, and hence the paltry return. The better news is that the running yield on the bond portfolio is now close to 5%. So if inflation can behave itself, better returns are potentially in prospect. At the top of the table, once again, our international shares option. Driven in large part by the very heavy weighting to the US market, which returned over 16%. And once again, the Australian shares option underperforming. This seems to be a perennial problem. 4 out of the last 5 years, 11 out of the last 13 years, our Australian shares option has underperformed the international shares option. Why is this the case? Well, I'm pretty sure that most of you know the answer, but here's another way of telling the story. Have a look on your screen. You have 10 years ago, the top 3 companies in Australia and the top 3 companies in the US. And by the way, these top 3 are still in the top 5 of their respective markets. Now, imagine that you're an investor and you've got this choice. You've got old economy stocks and new economy stocks. You'd probably think that this is a fairly obvious decision. But let me tell you, at the time, it wouldn't have been so obvious. Those tech stocks would have had a great run by then, and investing at those levels would have been seen as quite risky. Well, it turns out that risk would have been well worth taking. Consider these stats. Those Australian companies, they've done all right. The combined total value has increased by just over double. About 120%. Those global companies, they've increased in value by a combined 7.5 times. That's incredible. So the reality is that Australia doesn't really have a tech sector to speak of. And as we know, tech is the dominant investment theme of our generation. Now, as an aside, the US is not the only market with a tech story. There are others. South Korea, Taiwan, and Japan in particular. If you're wondering how those markets fared last financial year, take a look at this graph. Wow. South Korea up over 120%, Taiwan up over 80%, Japan up over 40%. Incredible numbers. So you might be wondering, why do we bother investing in the Australian market at all? Well, a few things here. Firstly, we have to look forward, not backwards. And looking forward, we believe the Australian market will meet the return and risk hurdles that we set for our options. Secondly, if we actually look over a much longer term, say 30 years, the Australian market has pretty much held its own versus the rest of the world. If we look over a really long period, over 100 years, the Australian market has actually been one of the best performers. Now, importantly, while the Australian market may not be as exciting as the US market, it is a higher yielding market and it's going to be potentially more resilient in the event of a massive market correction, particularly a tech wreck. Now, you might recall during the dot-com boom and bust. Leading up to the bust, we had that massive rally in tech in the late 90s, and Australia didn't really participate in that. But from 2000 to 2002, the Australian market was pretty flat at the same time that the US market fell about 45%. 2022, not that long ago, we had a bit of a tech wreck. The Australian market down about 2%, the US market down about 19%. So our market could be somewhat of a hedge against the possibility of a tech wreck. The question then is, are we actually going to have a bust in tech? On balance, I don't think so for a couple of reasons. Firstly, if we look at the valuations of the so-called Magnificent Seven, are certainly not in bubble territory to me. As a matter of fact, if you look at the rise in their valuations, it's pretty much tracked the rise in their profitability and expected profitability. And we didn't see that during the dot-com bubble and bust. The other thing is the market is discriminating between potential winners and losers. Now, in a bubble, everything rises, and we're not seeing that. And I want to illustrate with a reference to one of my favourite graphs. If you look on the screen now, you have the four big hyperscalers. These are the companies that are investing hundreds of billions of dollars of their free cash flow in chasing AI glory. And that's a bit of a concern to the market. But one company's investment is another company's revenue. And have a look at who's receiving the checks. That's right, the semiconductor companies. Look at their free cash flow. It's huge. Now, last financial year, if we look at the market performance of these companies, on average, those companies on the left, down 2%. Those companies on the right, the ones receiving the checks, up on average 138%. The rising tide is not lifting all tech boats. Now, to be clear, I'm not suggesting there are no signs of bubbles anywhere. And I am particularly concerned about the valuations I see in some of these private markets, the unlisted assets. Two best examples I can give you are OpenAI and Anthropic. Now, these are the owners of the two leading AI models, ChatGPT and Claude. Look at those valuations. Close to $1 trillion. And these are companies that are actually losing lots of money without the prospect of making profits for years to come. Now, I think they look a bit crazy, quite frankly, particularly when you consider that more and more users are moving to the much cheaper Chinese models. So we are avoiding investments in these types of companies. We're also avoiding investments in other flavours of the month, such as direct investments in data centres. In fact, we've reduced our tech exposure, taking some profits. However, we are remaining quite positive on the tech sector in the medium term. So we are maintaining an overweight position in our global portfolios and accepting the fact that it could be a volatile ride. Now, you might be wondering why I haven't mentioned the war. And the reason is because it's so fluid. And by the time this video goes to air, things have probably changed. One day, there's an announcement of peace. The next day, Iran and the US are bombing each other. As the saying goes, the first casualty of war is the truth, and this war is no different. I prefer to just concentrate on the oil price. Now, pre-war, oil was trading at around $65 a barrel. It shot up to $120, and now it's back around $80 a barrel. The general consensus is that even if oil trades between $100, $120 a barrel, that won't be enough to derail the global economy. And I'm just going with that. I think that's good enough to go with. I think what's important is to block out the noise and focus on the positives in the medium term. So, can our balanced option record a fifth consecutive year of double-digit returns? Well, of course, I'm going to say that's highly unlikely, but you've heard that before. Thank you very much for watching.